Investing is already complex enough. And on top of that, we've got all the disagreement among the experts. Ask 5 people what they think about something and get 10 different opinions. In this video, I want to resolve a conflict of 2 statements that by themselves look quite reasonable. The first statement is never lose money, as in try to manage your risk, try to be diversified. The second statement is it's never good to sell your winners. Let your winners run. Or in other words, the best time to sell Bitcoin is never. Right? This is what the Bitcoin maximalists say. The statements don't really go hand in hand until we clarify actually what we mean. If your net worth is worth several years of your income, do you want to have all of that money or the majority of that money in Bitcoin when Bitcoin can drop by 85% over here, or potentially by 83% over here, or potentially by 76% over here? Doesn't make sense to be that much in Bitcoin. When you have worked years and years and years to save up in Nest Egg, to maybe have 5 years of income in net worth, to then see those 5 years drop to only 1 year. That's of course not easy at all, and I don't advise doing so. Yes, at some point Bitcoin will recover again. It's very likely that it's going to outperform the US dollar long term, but there has to be a better way than just buying and holding Bitcoin with all of that money. So this video is about a less sexy topic. It's about risk mitigation strategies. And I've talked about one of those risk mitigation strategies several times on this channel, and I'm not going to dive into this in too much detail here. We're going to talk about something else instead. But what I personally do is I hedge my risk, as in I don't want to be in Bitcoin when we are below the 120-day simple moving average. I only want to be in Bitcoin when we are above the 120-day simple moving average. I've backtested all moving averages for Bitcoin, and the 120-day is the best to spare us from the majority of those bear markets. We still get some losses when we are correcting, but in general, the vast majority of the volatility disappears when we follow the moving average and when we are not invested whenever we are below that moving average. So this is risk mitigation strategy number 1. I do not subscribe to the idea of never selling your Bitcoin, but I do subscribe to the idea to always be exposed when the price tends to go up. It is okay to have the majority of net worth in Bitcoin or in crypto as a whole, even if the net worth is worth several years of income, if it is hedged, for example, with the 120-day SMA. But there's also another hedge. And I like to use several kinds of hedges because there are different kinds of risks. So you should have different kinds of hedges as well. Because while the 120-day simple moving average worked very well in the past, there's no guarantee whatsoever that it will continue to work well in the future. We also do not know what will happen to Bitcoin once we see a real financial crisis. So something similar to the oil crisis, something similar to the .com bubble burst, something similar to the global financial crisis, right? The mortgage-backed security crisis. It's always nice on paper to just say buy whenever we are below the realized price, when most people are in losses. Just buy then and sell whenever we are above. But it's much harder said than done, because if you wait for the realized price to get hit, then you might miss out on a rally that went from $300 all the way to $20K, just to then buy at around 5K. So you missed out on a 20x return if you're waiting for the realized price. Yes, it's always great to buy whenever we are below the average cost basis of the market, but we cannot wait for this time to occur. We can just look at this retrospectively and then get more exposure in that situation if we still have cash available. And that's the big if. Because here's the dark truth that nobody wants to talk about. Bitcoin has never really seen a real recession. What we see over here is the S&P 500, so the US stock market, but not in US dollars, but the price we'd see without monetary expansion. If the US dollar was not to lose value over time, so the S&P 500 relative to the money supply, then we'd see this chart. And this tells us a different story to what you see on most other channels, right? It tells us that stocks have the ability to drop by 74% over a very long period, right? This is 30 years of stock underperformance. And it can also take a very, very long time until we get our purchasing power back if we buy at the wrong time. This is 35 years of data. This was the oil crisis, this was the dot-com bubble burst, and this was the global financial crisis when Lehman Brothers went belly up. The vertical line here, that is when Bitcoin got launched. Bitcoin never really see anything significant. We saw the COVID crash, but you can barely see the COVID crash on this chart. This here was the COVID correction. But really, on a 2-week scale, it's just a little bit of a blip in an overall rising trend. And even those models like the realized price, they might completely break once this ratio here also turns negative more sustainably, as it did several times in the past. It's not just the S&P 500 relative to the money supply. It's also the S&P 500 relative to the earnings. This is the Shiller PE ratio. So this is a 7-year smoothed out price to earnings ratio. We are very close to all-time highs, and this should be at a somewhat constant level. It shouldn't go up over time because with stocks, we buy the future earnings of a company. So the higher the price now is relative to the future earnings, the more we overpay, the more expensive stocks are. And again, Bitcoin was created over here. It never really saw a real correction in the price to earnings ratio. But have a look at this. This is the S&P 500 relative to the gold price. And this now starts to get into the risk mitigation strategy I want to talk about in this video. This, by the way, here is a drop of the S&P 500 relative to gold of 95%. Or if you bought stocks at the beginning of the 1980s to the dot-com bubble burst, it would have outperformed gold by more than 4,000%. So the decision to be mainly in the S&P 500 or to be mainly in gold has world-moving ramifications. It's really important. The decision whether or not to get into Nvidia stock or into gold is much more important compared to whether or not to get into Tesla or Nvidia or Amazon or Google. All of those assets are highly correlated. The same is true for the crypto market, right? It doesn't matter what kind of altcoin is being bought. Most altcoins go up and down in the same manner as Bitcoin and Ethereum. Really what matters is where should the capital be allocated across asset classes? Should it currently be mainly in crypto or mainly in property or mainly in stocks or mainly in precious metals? That decision is much more important than the micro decisions within the market. And so just have a look at this, right? Do you prefer, when you look at this chart, to own more stocks or to own more gold? This chart implies that stocks are expensive, the same way as this chart does, the same way as this chart does. And again, Bitcoin was created here. We do not know how Bitcoin will react during severe crises. We did see that during the COVID crash, Bitcoin also crashed. It went down by roughly 50% in the span of 36 hours. I do not know what's going to happen during those kinds of movements. If Bitcoin will really become a hedge in times of crisis, we haven't seen that behavior yet, or if it continues to move like a risk on asset that's correlated to technology stocks. I think the former is more likely. And I do get the reservations. How can you buy gold right now when the chart looks like this, when gold is at all-time highs? Isn't that super stupid to now get into gold when it's at $3,500 almost, and when it's just rallied so much in the last few years? But really, that's not the problem. We have to put our money somewhere, and it cannot be in fiat currency because fiat devalues over time. This is the US money supply. It expands quite consistently over the years by roughly 6.8%. So every year you keep your money in cash and you don't have any interest on that, you are losing 6.8% in purchasing power. Or if your salary, if your income does not go up by 6.8% per year, you are falling behind year over year. It's the unfortunate truth. And so when we don't know what crypto is doing, but we do know that it tends to be somewhat correlated to the risky stocks, and we do know that stocks historically are extremely expensive, and that Bitcoin never has lived through a real correction of the stock market. We thus can't know what Bitcoin will do. We don't know what stocks will do. Is gold then really the right way to go about this? Is a gold purchase really the right thing? This is gold relative to the money supply, and gold does exactly what it's supposed to do. Sometimes it's cheap, sometimes it's expensive, but it keeps track with the monetary expansion. Yes, it went up recently, but in general, it tends to just keep its purchasing power as it should. And so let's play with that scenario. Let's say we are again at hyped times. So again, this is the S&P 500 relative to the money supply. And we're going to see some kind of a contraction. Who knows to what magnitude? This of course looks now very dramatic, but let's say stocks are now comparatively expensive and we could potentially in the next 5 to 10, maybe 15 years, see a real correction relative to the monetary debasement. How well does gold fare during times of crisis? So for example, here, when the S&P 500 relative to the money base was so high, what we see at the bottom is the gold price relative to the S&P 500. So how much would we outperform the S&P 500 if we held during times of crisis? Let's say we sold at the peak of the global financial crisis. The outperformance is 500%. We 6x our purchasing power by being in gold instead of stocks during those times. This is massive, right? Because this also means that if you want to get hedged versus our crypto exposure or versus our stock exposure, we don't necessarily need that much gold. We pretty much have a 100% hedge if we have 1/6 of our capital in gold. So that means roughly 15, 16%. Then you shouldn't lose any purchasing power. It doesn't take all of your wealth being allocated to gold to be protected. But of course, if you want to gain purchasing power, you need to have more than just 15% of your net worth in gold. You should rather have 20, 30, maybe even 40% of net worth in gold. I think this can be justified if you've got a sizable exposure to crypto and if your net worth is several years of your income. Crypto is likely going to go down further than the stock market during times of crisis. It already, even during a bull market, crashed by more than 80% several times. Maybe, I'm not saying this will happen, but maybe with a real global financial crisis, as we've never seen during Bitcoin's lifetime, Bitcoin could potentially go down maybe 90% from its all-time high. I do not know. I do not have a crystal ball, but I do know that Bitcoin is more volatile. And so if now the majority of wealth is in Bitcoin and you've got several years of your income in wealth, then it does make sense to be hedged aggressively. I don't think it's wrong to have 25%, 30% gold exposure if all of the remaining assets are 100% risk on. It's all Nvidia stock and Bitcoin, etc. I have a look here at the oil crisis, right? When the S&P 500 underperformed the monetary debasement by 75%. Had you bought gold instead of stocks during that time, you would have outperformed by 700%, so an 8x. And so really, it's not that expensive to move some wealth to gold. It's better than having the capital in fiat because gold does go up with monetary debasement. It's not like you're losing purchasing power holding gold long term. And yes, the current price is slightly above the historical average. And with slightly, I mean 30% or so. There is the potential for a correction. But I think there's much more potential for a correction in the stock market. Now, some people make the reasonable argument that it might make sense to rather buy silver instead of gold. Because when we look at the historical silver to gold ratio, silver is very cheap. And silver does have quite a bit of correlation with gold. As in, when gold goes up 10%, silver tends to go up 10% as well. And since silver is now relatively cheap to gold, why not use silver instead as the hedge? So this is silver relative to gold, a very long-term chart. It starts in 1931. And the idea is that silver is the better bet right now, that it could outperform gold by maybe 100%, potentially 170%, etc. in the maximum by even 400%, right? Why not buy silver when silver is here? Here's the historical average price. So silver could outperform gold by 73%. Now, the first thing I want to mention is that the decision between silver and gold is much less important compared to the decision between stocks and gold, because here the magnitudes are very different, right? This is 4,000%, not just a few 100%. So the decision between silver and gold is a micro decision. It's the same kind of decision compared to Bitcoin versus Ethereum. Really, the main decision here that should come from this video is, should I be more in stocks or should I be more in gold or in precious metals? And if I want to be in precious metals, how much do I want to own? This is the main decision here. But let's talk about the micro decision, because again, here at the bottom, one, we've got the gold price relative to the S&P 500. Now what we have here then, this is silver relative to gold. So let's again look at the recent double crisis, right? The dot-com burst plus the global financial crisis, where gold outperformed that much versus stocks. Silver relative to gold didn't really move much. It went down slightly. So the reason why we get into gold is to be hedged versus stocks or versus crypto. Silver is a good hedge as well, but it did not necessarily perform better than gold. It did slightly worse. There is more volatility in the silver price, and it does make sense to take advantage of those spikes. But in general, it doesn't necessarily look like silver is always the better option during times of crisis. It can be worse. And so gold is much more liquid. It tends to be much more negatively correlated with stocks. And so this is my primary allocation as a hedge. Having some additional allocation to silver as well does not hurt. Again, silver historically is cheap, but it doesn't have to be the main allocation, simply because of all of this random noise that we get in the silver gold ratio. Or in other words, I don't want to hedge my net worth with 20 or 30% silver exposure to just get these massive wicks to the ups and to the down that are pretty much uncontrollable, that don't really have that much correlation with what's happening with the rest of the portfolio. Again, this is an idea of risk minimization. And so this is then how we can bring those two statements together, right? On the one hand, we want to be always in Bitcoin, at least during positive bullish times, right? Whenever we are above the 120-day SMA, whenever Bitcoin tended to go up in the last 2 months, we are invested. But at the same time, we also tend to not lose much money because we sell whenever we are below the 120-day SMA, and we also have a nice hedge in case we see a historic correction that we've never had during Bitcoin's lifetime. Again, we are hedging here against something we have never seen in the past during Bitcoin's lifetime. And most people don't zoom out enough to be aware of this risk. Most people just think it's going to continue the same way as it did while Bitcoin existed. But again, in the last 15 years, we have been in a pretty constant bull market. People tend to forget this. People tend to take on too much risk. And I kind of understand this, right? Everybody wants to get ahead in life. We have to take our risks. But again, we don't have to take them blindly, and having a hedge does not take us that much further away from our goals. It's simply just another safety net because we don't get too many opportunities to actually keep our money during a crash. That's a nice thing, right? Once we keep our purchasing power while everybody else has lost theirs, we can pick up the pieces at very, very low prices. And that's then when real money is made. It's not just made during a bull market, it's made when the purchases during maximum depression happen. Now here's something I want you to avoid. Please do not follow people that tell you that there's the next 100x cryptocurrency where you're getting rich quick. Because you might have read about the statistic that 99.6% of pump.fun traders, so traders of smaller meme coins, did not realize a profit over just $10,000. The vast majority of people lose. The winners might be among those influencers, the winners might be among the insiders, and the rest is simply burning their money. And so because of that capital concentration process, because more and more people lose their money, ecosystems like pump.fun tend to shrink when there's no new marketing. And so what's the solution here? Because we want to make money over time, right? What's actually realistic if we can't make our 100x? There is a simple conservative solution. It's just dollar cost averaging. It's buying $1,000, for example, every month into something like Bitcoin. So do this for longer than a cycle, so for more than 4 years, in this example 6 years, then the performance looks like this. So had you dollar cost average into the S&P 500 or into gold, you have gotten this performance, but by buying into Bitcoin, you're getting this performance here. Now the time horizon matters here, right? Because there are bear markets. We include here a bear market where Bitcoin went from almost 70K all the way down to 16K. So at that point, the performance of the S&P 500 and gold and Bitcoin were very, very similar. But if the time horizon is long enough, then just within 6 years and just $1,000 per month, a comfortable nest egg of 360K can be built. It's not sexy, it takes longer, it takes effort, it takes contributions. It's not getting rich quick, but it's getting rich consistently. Now, I'm a fan of beating this, of course, because the crypto market is still very inefficient, but it's not inefficient in the way how you might expect. I am dollar cost averaging into my trading portfolio as well. This is my active trading portfolio measured in BTC. And my plan is to get to 8 Bitcoin within the next 2 years. Now, I didn't just buy Bitcoin with my trading portfolio. I actually did do active trading that did outperform buying and holding. I got this alpha here. So had I not dollar cost averaged, if I just paid into the trading portfolio once, I would have roughly doubled the amount within 48 years. So because I didn't just buy into Bitcoin, but I did do active trading, I'm now close to 5 Bitcoin and not just close to 2.5 Bitcoin. So what's more important? Is it the trading? Is it the regular contribution? The answer is both is important. At the beginning, the regular contribution is more important. At the end, generating the alpha is becoming more important, right? Because once this is at 3x, not just at 2x, then 2/3 of the Bitcoin in the portfolio is just due to alpha and is not due to dollar cost averaging. So both is important. Contributing is more important at the beginning. Trying to outtrade everything when the capital base is still small is not the smartest idea. Again, you've got a very high likelihood of losing it all. And so I'm actually doing the exact opposite of what most other people are doing. Most others try to find the next best altcoins. They have maybe a diversified altcoin portfolio, 10, 20 altcoins, and they try to beat Bitcoin that way. But more often than not, this fails. If you listen to people like this, how ApeCoin will be the next 100x investment, this video was published 8 months ago, then you would have underperformed Bitcoin by 44% since then. Now, this is not just in the last 8 months. Have a look at what ApeCoin did prior to that. It just underperformed Bitcoin extremely consistently. And so that's how everybody gets wrecked. That's how the majority of people lose. Most people buy things that get recommended by influencers, and very often those influencers get paid by the different crypto projects to do that marketing. I, by the way, never take any money from any crypto project ever. The only money that I take is from the premium members that support this channel here. But more of that in a second. Here's the reason why ApeCoin did so poorly. The supply increased over time massively, and the early insiders at the team, etc., they get token unlocks over time and they dump those unlocks on the market, which makes sense when your token performs like this relative to Bitcoin. So this as well is a self-fulfilling prophecy. If most people expect a token to do worse than BTC, then the selling pressure will just continue. And so my approach is to just flip this whole thing around. So instead of trying to find the best altcoins and buying them and having a diversified portfolio of altcoins, I'm just betting on falling prices of altcoins relative to Bitcoin. So I go long Bitcoin, I bet on rising prices of Bitcoin, and I go short the altcoins that are extremely poor in long-term performance. So instead of this chart, I've got the performance of this chart here. So there's now Bitcoin relative to ApeCoin. And what we see here in white, that's just the Bitcoin price. As in, Bitcoin does have its drops, but relatively speaking, since ApeCoin is so inflationary, it tends to do so much worse. And so over time, it tends to just very constantly outperform just plain old holding Bitcoin. So there's a better strategy to just buying and holding Bitcoin. There's a better strategy to just dollar cost averaging into Bitcoin. And it's not finding the next 100x altcoin. It's betting on falling altcoins because the insiders are cashing out constantly. That's actually how we can beat the market. And that's what I'm doing for the last 4 years. And so I want to share this strategy, of course. It's not as straightforward as just buying an altcoin. We do need to use decentralized finance applications. We do need to do some risk management here, but long term, again, it's worth it. I have made many tutorial videos on the topic, but in the end, you only need 2 videos, 2 very important videos just to copy trade what I do. So that's this video over here, using perpetual futures to bet on relative valuations, and this video over here, risk management with relative valuation bets. Those 2 videos in total amount to roughly 1 hour of content. After you've consumed this content, you can do bets like this. Now, many altcoins are inflationary, and so there's many such opportunities. I also have one favorite trade where the outperformance is very, very constant, where the volatility is very low. I will share that favorite trade once you join. So after you've watched those two videos and you've joined the community, I will share my favorite trade. And if that favorite trade does not make money after 1 month of holding, then I will refund the premium membership fee for you, no questions asked. So it's currently $125 per month, and if you don't make money with that trade in that month, you will just get that money back. So you're not really risking that money, and you can watch all the tutorials in premium, not just the two that were mentioned here. So feel free to explore premium without any risk. A link to the website should appear directly here on the screen. If it's the very first time here, feel free to subscribe. I publish this regularly. A like would be very much appreciated as well. It helps the channel grow. See you next time on YouTube, or see you in premium. Cheers.